Okay, this is the chapter 20 video, that last assignment question that we didn't finish off, again looking at basic and diluted EPS. The shareholders' equity of Cameron Corp as of December 31st, 20x6 at the end of the current fiscal year, which is going to be important. We had $1 cumulative preferred shares convertible at a rate of 4-to-1, 350,000 outstanding. You can see the value there. We had 3.5 million common shares outstanding. We have some common stock conversion rights and our retained earning balance. We have events that have occurred throughout the year. So on July 1st, 150,000 preferred shares were converted at that 4-for-1 rate. We had convertible subordinated debentures outstanding with a face value of 4 million due in 20x12, at which time they may be converted to common shares or repaid at the option of the holder. Conversion rate is 12 common shares for every $100, interest expense of $175,000. Convertible preferred shares have been issued in 20x0, quarterly dividends, 20x6 net earnings, tax rate of 30%, common shares traded for an average price of $18. They had employee stock options outstanding all year. The options were to purchase 600,000 common shares at a price of $14 each. Options became exercisable in 20x3. Cameron had another 100,000 employee stock options outstanding at an exercise price of $22, expiring June 30th. So we need to do all of our EPS presentations, so showing both our basic EPS and our diluted EPS. So I've pulled, again, all of the relevant information down into our Excel sheet so that we can complete this chart using our Excel formulas. So first thing we want to start off with is our basic EPS. So we need to look at our net earnings for 20x6, which were $2,289,000. Okay. We know that we're going to deduct from that what is not available, which is going to be the dividends on our preferred shares. So here's where it becomes important that we are given information for the end of the year. So we had 350,000 preferred shares outstanding at the end of the year. There are $1 dividends, but payable quarterly. So it's $1 for the entire year, which amounts to 25 cents per quarter. And these were converted July 1st. Okay, so that means that for the first 2 quarters of the year, we had actually 500,000 outstanding preferred shares, right? 350,000 plus 150,000 is 500,000. After July 1st, we converted 150,000 of these shares, and that's when we were reduced down to 350,000. So we are going to have 2 components for our preferred dividends. We need to look at the first 2 quarters of the year, which, as we said, had 500,000 outstanding times 0.25, 25 cents, and that was for 2 quarters. And then for the last 2 quarters of the year, we were down to 350,000 preferred shares outstanding, receiving a dividend of 25 cents apiece for 2 quarters. Okay, so times 0.25 times 2. I'm going to make this a negative number because we want to deduct this from our net earnings, right? Same thing here, although I think, yes, I have this pulled down so I can use my Excel formula. Okay, so our dividends for the year amounted to 250,000 and then 175,000. I'm going to move this down one. So we have, there we go. So our net earnings that were available to common shareholders for our basic EPS calculation was going to be 1,864,000. So now we can look at our weighted average of shares. Okay, So again, this 3.5 million was at the end of the year after we had our conversion, right? So we had less than that for the first 2 quarters of the year. Okay, so we converted 150,000 preferred shares, and it was a rate of 4-to-1. Which means that we had 600,000 common shares that were added. So if we take our 3.5 and we subtract these 600, that means at the beginning of the year we actually had 2,900,000 common shares outstanding. After the conversion took place and we added in this additional 600,000, that's when we got up to our 3.5. Okay, this conversion happened in July, which means for half the year, so 6 months, we had this amount, and for 6 months, we had this amount. So we want to look at the weighted average of that. Okay, so our weighted average shares, let's start with our 2.9 times 6/12. I don't know why I put it in that box when it should be over here. And that gives us an amount of 1,450,000. Our 3.5 times 6/12 is going to give us 1,750,000. Excuse me, giving us a weighted average of 3.2. So when we divide our net earnings by our weighted average shares, we get a basic EPS of 58 cents. So that is basic EPS. Now we can move on and look at our diluted EPS. So we are looking at all of our convertible securities that could have an impact on our EPS if they were all to be exercised. Okay? So we want to look first at the individual effects of each of these. So we have our preferred shares, we have our debentures, we have options. Okay, so we're going to start with our preferred shares, and we need to break this down into 2 categories. We have the preferred shares that had been converted, right, in July, and then we have the unconverted preferred shares. So starting with what has been converted, we want to figure out what are the dividends that we can avoid. Okay, so we had 150,000 shares that were converted. They received a 25-cent dividend for the first 2 quarters. Right, 150 times 2.5 times 2 gives us an amount of 75,000. So that is our numerator. Those are the dividends that we can avoid. Okay. Now we need to look at what was converted, which was the 150,000. Those converted into 4 common shares. And this is for half the year, right? Because it happened in July. So 300,000. So our individual effect is 25 cents. Okay, this is less than our basic EPS, so it has the potential to be, dilutive, sorry. So next we're going to look at our preferred shares that were not converted or unconverted. Okay, that was our 350,000. If they were all converted, we could avoid the entire year's worth of dividends, which amounts to $1. And if we did the conversion, it would turn into 4 common shares. The individual effect of that being again 25 cents. Okay, so next we are going to look at our debentures. Where's my info on that? So they had convertible subordinate debentures outstanding with a face value of $4 million. They can be converted to common shares, 12 common shares for every $100, and we have interest expense of $175,000. Okay, and don't forget that we need to look at the tax implications of that interest expense also, because that interest expense was deducted from our net earnings before income tax was calculated. So when it comes to the debentures, on the numerator is going to be that interest expense that we could avoid. So our interest expense was $175,000. And we want to look at the tax effects. So we take 1 minus the tax rate. And that gives us an amount of $122,500 that could be avoided. On the bottom, we have $4 million face value. Okay. And for every $100 of that, we can convert into 12 shares. Times 1 over 100 times 12 gives us an amount of $480,000. Get rid of some of these decimal places. Okay, and that gives us an individual effect of 26 cents. That is so far the most dilutive, right? Next, we look at our $14 options, okay? And we're going to use the treasury stock method here, okay? So the first question we ask is if these options are in the money, okay? Our market price was $18 per share. Our options were 14, which means that they are. So we're going to look at the shares that would be issued if they had been converted. And it was 600,000 common shares. Okay. But we know that from the income from those options being exercised using the treasury stock method, we would retire shares as well, right? So if we were to retire shares, so we have 600,000 that were exercised at $14 a piece, we would purchase as many shares back as we could at $18 a piece. Okay, so 600,000. I don't know why I pulled it all out to use Excel formulas. I just don't want to keep scrolling. That's why I'm typing it in instead. Okay, so we could retire 466,667 shares. So we're going to leave that piece of information as it is for right now. Okay, we're not bringing that down any further. And we're going to look at our $22 options. So the $22 options must be evaluated for the period during which they were outstanding, which is only the first 2 quarters of the year. Okay, so because they expired on June 30th. So they were only outstanding for the first half of the year. Okay, they had an exercise price of $22. Our market price was 18. They were never in the money, so they were never converted. And they have now been extinguished. Okay, because they were not in the money in the first 2 quarters of the year, They are considered to be anti-dilutive during that period, and so we would exclude them from our calculations regardless. So these were anti-dilutive for the first 2 quarters and have since been extinguished. Okay, so now we're going to move on to our diluted EPS. We're going to start with basic like we always do. And then we are going to include each individual based on their individual effect. Okay, so we start actually with these options, okay, which would reduce the number of shares outstanding. Well, would increase it and then reduce it some. Okay, options don't have an effect on our numerator, which is why we don't have like a number like this when we are looking at the individual effect. Okay, those options only affect our denominator. They are only affecting the number of shares outstanding. So let's start with our basic EPS, first of all. Okay, we did these calculations up above. Our net earnings, 1,864,000. Our weighted average shares, 3.2. Excuse me. Which gave us an EPS of 0.58. If the options were exercised, it would add in an additional 600,000 shares, but we would retire 466,667 of those. Okay. So after each individual component, we do a subtotal. Our numerator, again, did not change, but our denominator did change. Okay. Calculating our new EPS, we now have 0.56. So now we can start including our preferred shares. So we're starting with these backdated shares, which refers to those that had been converted. Okay, so 75,000 was the impact to our numerator. Those were the dividends that could have been avoided, and then the 300,000 shares. Okay, so bringing that in, 75 would have increased our common shares outstanding by 300,000. We do another subtotal. Bugging me that this is not playing the way I like. There, and fix that. This should be decimal place. Okay. So we have our new diluted EPS of 0.53. Now we bring in the rest of those preferred shares. Excuse me. Excuse me while I die on video. Goodness, sorry. 350,000 was the impact to our numerator or our net income. And then we have an increase to the number of shares outstanding. Wow, can't talk anymore. Sorry, I was going to push through the end of this video. I'm losing my voice. Sorry. So again, we look at the effect by adding the dividends that could have been avoided back to our net income and increasing the number of shares outstanding. Okay, we now have an EPS of 45 cents. Now we finally come to our debentures, which I think I said were the most dilutive, but really are the least dilutive. I'm sorry. And we include the information on that. So if those had been converted, we could have avoided $122,500 in interest expense, but we would have increased the number of shares outstanding by 480,000. Adding all of that together and all of this together, calculating our new EPS, we now see that our worst case scenario is going to be an earnings per share of 44 cents. Okay, so the EPS disclosure on these statements are basic EPS 58 cents and our diluted EPS 44 cents. So that's it. That is, sorry, didn't mean to scroll there. That is the end of the assignment question. So you are all caught up now for both chapter 19 and chapter 20, and I will see you all at the beginning of next